I would like to share you my views on the market and hope that it will help you make a profitable investment. Okay, so sorry about that. But anyway, I'd like to start out by telling you what happened in the first half. So if you look at it, our stock market actually did quite well. And when we did our briefing, we were talking about how we were quite optimistic about the market because during the start of the year, I think people were very much concerned about COVID-19 and, of course, the lockdowns that are happening. And then we had the Omicron variant. And well, if you think about it, during the first 2 months of the year, the market performed quite well until, of course, an unknown happened, a risk, which was the war in Ukraine. It erupted around February 24. And after that, the market started to weaken. On March 17, that was the first time when the Fed actually started raising rates, which, in a way, people were expecting. But the problem was when it started raising rates, its forward guidance was a lot more hawkish than people expected. And it started talking about how, it had to address inflation more aggressively. And after that, every month we saw inflation in the US continuing to go up and beating expectations, which is why the market kept on going down. Okay, so can we go to the next slide, please? Okay, so as you can see, in the Philippines, for example, our inflation went up sharply. And I think the latest number in June was more than 6%. I think it was 6.1, reached 7.1%. Now, historically, I think our 10-year bond rate was only averaging around 5%, but it reached around 7%. And of course, we know that's not good for the stock market because in some ways, the high interest rates act like a competition to money going to stock. And let's go to the next slide. And aside from that, another problem that happened was because the US was very aggressive in raising rates, it had raised rates by a total of 150 basis points, for example, whereas the Philippines at one point only raised rates by 50 basis points. And other central banks also around the world were raising more funds to flow into the US because the dollar assets were giving higher yields. Therefore, this led to a stronger US dollar. As you can see, for the year-to-date period, the peso has depreciated by more than 10%. But if you look at the dollar index, the performance of the US dollar against, say, a basket of currencies, including, say, the euro, Japanese yen, and other currencies around the world, you can see that a large part of the weakness of the peso is due to the strength of the US dollar because of the aggressiveness of the US Fed. Okay, let's go to the next slide. But, sorry, the good news is we feel that the worst could be over soon. And we think that the worst as far as inflation, interest rates, and the peso could be behind us because of three reasons. First is that we're already seeing commodity prices go down. Second is there's a growing likelihood that the US would enter into a recession. And finally, global central banks are fighting back by also tightening their monetary policies to prevent their own currencies from weakening against the US dollar. So let's go to the next slide. Okay, so as I talked about the war in Ukraine, it was one of the major drivers of the high commodity prices, and of course, the pandemic also created supply bottlenecks, and of course, the stimulus brought about by the low interest rate, etc. But then, as you can see, for the year-to-date period, based on the CRB index, which is an index that measures a basket of different commodities, which include industrial commodities like copper and soft commodities like wheat, which comes from Ukraine, and even palm oil and so many other commodities. You can see that for the year-to-date period, actually, after going up sharply the prices of commodities are already down for the year-to-date period. I mean, it's not across the board, but in general, the trend is it has peaked and has gone down. And even oil, if you look at it to the right, which is a commodity that is very sensitive to the Russia-Ukraine war, I mean, it has gone down from a peak and is now back to um, pre-Ukraine war level. It's still elevated, but at least it's not as high as it used to be. Okay, so that's one good news because if commodity prices are now cheaper, then of course it would lead to less inflation. Next slide. And then another reason that I talked about why, inflation and high interest rates may no longer be an issue is there are increasing signs that the US um, is entering into a recession. So I think in January, I already talked a little bit about this because inflation was somewhat of a problem already. Um, but here you can see that this indicator continues to show signs of weakness. Okay, in the US sentiment index. And as you can see, the sentiment of consumers in the US is very pessimistic. Okay, to the point that it's actually worse than global financial crisis levels. Okay, because consumers don't have a lot of confidence to spend anymore because prices are so high that they feel very poor. Okay, so that's one negative thing. And if you're not very confident about your situation, then it will prevent you from spending a lot of money, which of course is not good. Let's go to the next slide. Okay, and just earlier this week, I think this is a very strong indicator because prior to this, you would see other indicators that would say that the US remains very strong. But earlier this week, we finally saw this flash PMI. So anyway, when you read the PMI, anything that is above 50 means that there is an expansion going on. Anything below 50 means that there is a contraction. And for the first time, it is below 50. So it shows that there is some contraction happening. And then if you look at the comments of the chief economist covering this, and it talks about how consumers are spending less, both I think in terms of products and also services. Now that inflation is so high, interest rates are so high, so the rising cost of living is hurting their ability to spend and their appetite to spend versus earlier on, like say last year, the US economy was very strong because there was pent up demand. So the revenge spending is no longer there. No, so this is another sign that the US market or the US economy is weakening. Next, okay, let's go to the next slide, please. Okay. And then another indicator is the yield spread. Okay. The yield curve in the US has inverted to the point that the 2-year bond actually is trading at a higher yield compared to the 10-year bond. Okay. So this is another indicator that the economic outlook is deteriorating or another sign of recession. So, if there are signs of a recession, of course, and you are the US central bank, you are the Fed, first of all, it just means that inflation is less of a problem because if the economy is weak, it will, weaken demand for commodities. And of course, for businesses, it will make it more difficult for you to pass on the higher costs. So, that should address inflation problems. And if inflation is no longer a problem, you being the central bank will no longer be raising rates. So I think because of that, the inflation and high interest rates will no longer be a problem going forward. I know that the Fed just raised rates, I think 2 days ago, but as analysts, we have to be forward looking. And if I'm looking at these indicators, I think there is a strong likelihood that the Fed, even if they raise interest rates, it will be, the last few ones. And or it may already stay on hold. Remember that during the press briefing, uh, Chairman Powell already said that, oh, we will be more, we will not be giving any more forward guidance, and we will be looking at the indicators more going forward. So it could be a sign that they are softening their stance on inflation already. So it will be interesting what happens in the next few months. Okay, let's go to the next slide. And yeah, finally, central banks are now raising rates. So if you look at the left side, you will notice how most central banks are raising rates. Okay, so the yellow orange color would indicate ones are those that are cutting. And you will see, for example, that it's right now it's Russia and China that have, they're the only two countries so far that I'm aware of that have cut rates this 2022. All the other countries are finally raising rates. I mean, even our BSP that initially said that they're not gonna be raising rates because the currency is not that much of a problem. They did an off-cycle rate hike of 75 basis points, and they're talking of more rate hikes in the future as necessary to prevent the peso from depreciating substantially. And even the ECB, the European Central Bank, after 11 years, they finally raised rates. So global central banks are now recognizing that they can't just stand still while the US is aggressively raising rates and allowing their currencies to weaken, because if your currency is weak, of course it's also inflationary, because if you import products and they're denominated in US dollars, that will cause higher inflation. But right now we're seeing global central banks raising rates, and that should keep the local currencies from depreciating substantially. So let's go to the next slide. Okay, so another good news, in the start of the year, we didn't know if for sure if COVID-19 would still be a problem, but that said, right now we are seeing a little bit of a surge in the number of cases, but the good news is we're learning to live with it. And maybe because more Filipinos have been either infected with the virus or have been vaccinated, you will see that although the number of cases are going up, the number of deaths have not gone up as much. So that said, there is a smaller likelihood that the government will have to tighten restrictions again and lock down the economy. And next slide. And earlier on, one of the risks that we talked about, early this year was political risk because there was an election. And although Marcos was elected as president, I think the good part is, he appointed a qualified government or economic, a very, very impressive economic team. As you can see, they are very qualified if you look at their educational attainment and qualifications. And for me, what's impressive also is that, it didn't matter that these people were not, I would say, not entirely loyal to Marcos. As you can see, they worked under different administrations, under different presidents. So, I mean, loyalty was not a priority when they were picked, but rather their ability to lead the country and help the economy recover, which I think is very good. I think this addressed some of the concerns of investors who, earlier on were a bit concerned what would happen if Marcos becomes president of the country. Okay, so anyway, so this is the bad news though. Although we may have seen the worst as far as inflation is concerned, and then the other issues have been addressed. An economic slowdown is expected to happen, or at least a slower growth is expected to happen. And if that happens, then this would hurt corporate profits. Okay, and because of that, the stock market could stay depressed. Okay, for example, inflation has already gone up, and to address inflation, we know that central banks have been raising interest rates. And because of that, we could see slower economic growth. We know that, for example, the IMF and the World Bank have been reducing our GDP growth forecast for the whole global economy. And even the Philippines, we are affected. And because of that, although analysts like me are forecasting EPS growth of the PSEI to be 11% this year, there is a risk that we might not meet that 11% growth. And because of that, because of the uncertainty, we know that investors don't like uncertainty. And because investors are uncertain, or they have this concern, they are a bit gun shy, and sentiment for stocks is poor, so risk appetite is not there. Okay, let's go to the next slide. Okay, another potential issue is that our new administration has limited fiscal space. So as you can see, because of the pandemic, our debt to GDP ratio has gone up quite a bit. So from in 2019, our debt to GDP ratio was only 39.6%, but as of March this year, it's at 63.5%. So it is a little bit high. I wouldn't say it's alarmingly high, but it's a bit high. And of course, because our economy weakened a lot during the pandemic, our deficit is also very high. Okay. So although this is something that can reverse, the government has to be more disciplined in terms of spending. So because of that, you might not see a lot of pump priming coming from the government going on. And then let's look at the next slide. Next slide, please. Okay. So I think prior to stepping down, the finance secretary before, Secretary Dominguez, was talking about more taxes. But under the new administration, Secretary Diokno was saying, no, we cannot increase taxes. But because of that, they're saying that we will grow out of the debt problem, and our debt to GDP will only go below 60% by, I think, 2025, 2026, until, it goes down to around 52% by 2028. Well, this could create some level of uncertainty. And of course, it is, I guess, it risks the country suffering from an investment rating downgrade. Okay, let's go to the next slide. But that said, the reason why we remain optimistic about the market is because we feel that potential earnings downgrade or downside risk is already priced in. So as you can see, the index stocks right now are currently trading way below the historical average PEs. So among the index stocks, we only have maybe 5 issues that are trading above their historical average PEs, with the index itself trading at around 2 standard deviations below its historical average PE. So that means it's very cheap. So if sentiment improves and there will be a mean reversion, of course, that just means that the prices will go up again. Let's go to the next slide. So, okay, earlier on, we talked about a potential earnings downgrade. Okay. So we are now at around the 6,200 level, 6,300 level. So it depends on, among us analysts, we can argue amongst ourselves based on the 10-year historical average, or a 17 times P, which is based on a 5-year historical average. So no matter what you choose, assuming that there will be a mean reversion and then will return to 17 times or 18 times PE at the 6.2 level, this already assumes that there will be a 16.8% downgrade in earnings forecast for this year if we assume an 18 times PE. If the appropriate PE is 17 times, on the other hand, it already prices in a 13% reduction in the earnings forecast. And on a year basis, it also implies a downgrade. So earlier on, I talked about the consensus forecast, which is an 11% increase in EPS. But with a price of 6,200, um, it seems like the investors do not agree that there will be an 11% increase in the forecast. What's already being priced in is that there will be a reduction in earnings this year. Next slide, please. And aside from that, okay, I think what's important is you will notice that a lot of companies are buying back the shares um, to the point. And I think, what I'd like to highlight here is if you look at the current price versus the average purchase price of the companies, you will notice that they actually started buying much earlier because these companies believe that the price of their shares are already very cheap, which is why, why would I buy shares of other companies when my own company is already very cheap? So a lot of these companies have been buying back their own share. And let's go to the next slide. Because you will see that even the insiders themselves, the owners of these companies and the officers are buying back their own shares. And again, similar to the earlier slide, you will notice that these insiders have been buying back their shares at prices that are even higher than what they are right now, which is why I think, we can't afford to be too pessimistic because only during difficult times like this can you actually buy shares of companies at a very cheap price. The fact that the insiders and the companies themselves are buying back their own shares means that they are confident about their own long-term outlook, and if conditions normalize, they believe that they will make a lot of money. Okay, let's go to the next slide. Okay, so now let's talk about strategy. I'll be honest with you. I am an analyst for equities, but I think in the short term, there is a possibility that bonds and REITs will perform better than stocks. Okay, because when interest rates go down immediately, bonds will benefit because for sure, diba, when you buy bonds, you have fixed coupons. So if interest rates go down, definitely you want to buy an instrument that will provide you fixed returns. Those fixed returns are going to be more valuable because you don't have any other options where to put your money to get those fixed returns. Therefore, the price of these bonds will go up. And even REITs, because the REITs will provide the same kind of cash dividends, then therefore we can expect the prices to go up. And I think if you already look at the bonds, you will see that the prices of bonds have already gone up. And I mean, think about it. Last year, people were scrambling to buy, looking for bonds that could provide yields north of 6%, even north of 5%, and even REITs. It was so hard to buy them during their IPOs, but now they are actually, a lot of them are trading below IPO price. So I think it really is a good opportunity to buy them, especially now that yields are starting to, have peaked and are starting to go down. So I think first, they will be the best performers in the next 6 months. Next, if you're gonna buy stocks, no, okay, can we go back to the previous slide? If you're gonna buy stocks, I think let's first stick with the defensive names because again, there are still concerns about economic growth. So if you're gonna buy stocks, let's stick to companies whose earnings will remain strong regardless of what happens to the economy. These would be the power companies, telcos, and some consumer staples. And then as far as companies in the material space, those that are in, say, coal, nickel, etc., maybe it's time to take profits on them as commodity prices are already going down. And as for the other issues, okay, so there are a lot of issues that there may be concerns about their earnings in the near term because the economy could be weak. With that said, I think it is a good time to actually start peso cost averaging on them because at least, you have one problem that's down, which is inflation or their cost side. So the risk now is on the demand side. But then again, um, eventually that should recover. And if that recovers, then the prices will no longer be where they're at. So anyway, when you buy them, it would be nice to stick to the larger cap issues that have strong balance sheets so that they will not be vulnerable to say potential defaults, and pay dividends so that you could actually hold on to these stocks for a long time. Let's go to the next slide. Okay, so as far as our stock picks are concerned, so here are the REITs that we like. We like M-REIT, C-REIT. Actually, if you look at the list of REITs, they're actually quite strong, those that have listed so far. But, these, in our opinion, provide high levels of dividend yields that may seem more attractive or look more attractive at least. And then for power companies, we prefer Aboitiz Power. For the telcos, we like Converge because we feel like it's in a space where growth is still very strong and the valuations have gone down quite a bit. Then for the consumer staples, our favorite is URC. For the next set of companies that we like, so these are companies that we think would be good to start your peso cost averaging journey. So we have Ayala Corp, SM, and GT Capital for the holding company space. And then BDO and Metro Bank for the banks, and Ayala Land, Robinson's Land for properties, and then DNL and Pure Gold for the consumer stocks. Okay, next. Can I have the next slide? Okay. So, because I know that I recommended quite a bit of stocks. So just in case you want to, shorten the list. Okay, I've highlighted the stocks that I like among those. So if you only have, say, budget to buy a few stocks, then it's Ayala Corp, SM, BDO, Ayala Land, and DNL. Okay, next slide. Okay, so in summary, the stock market has performed poorly for the year-to-date period, mainly due to high inflation and interest rates, and the weak peso. And the good news is the worst might soon be over because of falling commodity prices, a possible recession in the US, which increases the likelihood that the Fed will stop raising interest rates. And coupled with a more aggressive BSP, this could stop the peso from depreciating further. And the bad news is, although inflation and interest rates and even the peso have peaked, the economic growth outlook has deteriorated, and this could hurt earnings and sentiment for stock. Next slide. Okay, the new administration also has limited fiscal space given the government's large deficit and high debt to GDP ratio. This could limit its ability to pump prime the economy, risking a credit ratings downgrade. Nevertheless, we remain optimistic because we believe that the negatives are already priced in numerous companies, and their insiders are buying back shares in their own companies, which, in my opinion, shows confidence in their long-term outlook. And among the different asset classes, we think that bonds and REITs will perform the best in the short term because of their steady interest income and dividends, which are more valuable in a falling interest rate environment. Next slide. So among the stocks, defensive stocks from telcos, power, and consumer staples should perform the best in the short term. So since inflation is no longer an issue, we also think it's a good time to start accumulate growth-oriented stocks that are trading at very attractive valuations. So we recommend focusing on large cap stocks with strong balance sheets and cash dividends. So with that, thank you very much for attending my session.